Hello everyone. I'm recording a video here on this Friday because there's been some turmoil in the markets this morning. In the US market is not open yet, but what we can see already is that the Nasdaq is trading sharply lower. Once again, Trump is wreaking havoc in the stock market. So President Trump recommended a 50% straight tariff on the European Union. And so the reason I decided to record this video is exactly because volatility is here to stay once again. Trump is only 4 to 5 months into his term, but we can see that volatility continues to trickle in. And sure enough, I mean, look at that. Ever since he took office, you can see that the market's already down, crashed 20%. Then it rebounded sharply. Okay, it's just right now it's just a bit shy of all-time highs. But now it's trading, it's already down 2% on the back of those news. So volatility is definitely here to stay. And the reason you see a smile in my face is because I'm a long-term investor. And if you like buying great companies when they are more expensive, then you sure the hell should love to buy them when they are trading at cheap valuations. And this is what I strongly advocate you guys do. Okay? Don't chase hype. There is going to be more volatility, and the matter of fact is that you can look at what I'm doing with my own money. And ever since Trump took office, I already bought 3 companies. I added 3 companies to my portfolio. Altogether, I still I have 5 companies in the portfolio. For transparency, you can see all of them. I've been sharing my positions very transparently on YouTube and across social media. You can see that. Without the volatility provided by Mr. Trump, I wouldn't be able to get in at such attractive valuations. For example, I can see that Louis Vuitton, on the back of this news, is down another 4 to 5%. But where we are going to make money is we need to differentiate between short-term noise and long-term fundamental changes. And that's not the case. So I think these tariffs, yes, they're going to have, if implemented, if they do go ahead with them, that this is going to have major implications on companies' top and bottom lines. But I think it's not going to deter, it's not going to cripple these businesses. These are well-established companies, and we are talking about the largest luxury empire in the world, in the case of LVMH, and the stock is down 50% from the highs. And for me to see this company, seeing this company trading even lower makes me happier because I'm going to be able to add to my current position. Remember, initially when I bought at an average price of, let's say right here. Let's see, you can see that I got in at 498 euros. So I only bought 1 share because I wanted to make it a larger position. But the stock shot higher and I didn't manage to do so. But now it's coming back in once again, and this will allow me to bring my average cost per share down, hopefully to the $390 range. So let's see if this continues. But very happy about that because to me the fundamentals have not changed, and it's very nice to see that insiders continue to scoop up shares as well. So it's an incentive. It means there is an alignment between what management is doing and shareholders, which is something that I really like. So we're talking about the founder-led, we're talking about a family-owned business here, a family-led company, and I don't think they're going to go away for sure. So look, there's a lot of uncertainty. For example, Ray Dalio, which was one of the biggest macro guys, he said, you warned of 2008 market crash. U.S. Treasury, who warned of 2008 market crash, says U.S. Treasury risk greater than what Moody's downgrade suggests. Some of the volatility, that the weakness that we are seeing is on the back of Moody's downgrade of the U.S. credit, right? So they say the U.S. deficit is growing crazy, is going to get really high. So it's just exploding essentially, and that is going to make it more difficult for the United States to pay the interest on the debt, for example, right? In this, as it's understandable, causes uncertainty among investors who demand a higher interest on the money that they are borrowing. Okay, and that's why we are seeing yields going up while bonds are coming down. Of course, it has major implications. And sure enough, if bonds go down and yields go up, this means that it means that it makes stocks less attractive. Okay, because remember that bonds are perceived as having as less risky, and so investors would prefer bonds than over assets, provided those yields continue to go up. So look, the point that we need to make here is that we don't, instead of focusing on things we cannot control, and for example macro things, we don't know how the relationships between the US and China, or US and the European Union, are going to play out. Those are things outside of our control. But what we can control is, number one, remember the companies that we are analyzing and the price that we are paying for those businesses. So here's my suggestion. Once again, make sure you are building your watch lists and make sure you are valuing those companies. So when the time comes and we see more weakness, then you can pull the trigger on those companies and set yourself up for financial freedom. And this is what I'm doing with my own money. And it has proven over decades that it does work, right? And you can see that my portfolio has been outperforming the index ever since it was launched, and I should expect that to continue. Okay, so happy compounding, and let me know in the comments below if you do like this video and if you want me to record more of this.